But where else is the market headed? Who better than Rajeev Thakkar, CIO at Parag Parag Mutual Fund, joining in on the show right now to chat about the markets. Rajeev, good to have you in the studios, and a very happy new year, firstly, from all of us.
Happy New Year.
Okay, so is it really going to be a happy new year, considering your mutual fund has exposure to both global as well as local stocks? Where do you see both the clusters moving?
When we chatted in beginning of 2018, I wasn't too upbeat. Today I'm a bit more upbeat than I was last year, purely from the fact that stock prices haven't done much except go down in the small and mid cap space. Large caps are pretty much where they were. In the year, obviously companies have gone ahead in terms of volume growth, profit growth, or cleaning up their past balance sheet issues or NPA problems or things as it may be. So I think given that the starting valuations are better than what they were earlier, we are in a better position in 2019. And some of the worries that we had, primary being a runaway increase in interest rates or withdrawal of liquidity by the Fed, or worries on currency or crude oil, those are behind us. So I think 2019 should be reasonably okay.
That's locally. What about globally, considering you have exposure to global names too?
Globally as well. So globally, the rally we saw in the US markets on Friday and what we are seeing in the Asian markets today, it's primarily where the Fed has recognized that you cannot put the genie back in the bottle. The increase in the balance sheet size that happened post global financial crisis, all that money cannot be withdrawn from the market. So they'll have to do part of it and they'll have to let part of it remain, and interest rates are not going to increase in a steady manner. They'll look at data and be more gradual and sanguine about it. So I think that's a big message even from the global markets, where we saw a big bounce on Friday.
As a fund manager, is there a differentiated strategy before the elections and post the elections? I mean, in your mandate to your team, how have you asked them to position themselves around the event?
We are looking for attractive companies, attractive opportunities in companies that we like. Whether that opportunity comes pre-election or post-election is fine with us. We have, as you know, a certain amount of cash. It had peaked at about 30%. That has come down to 25%, and we are buying month on month a little bit. We would buy if there are opportunities. We wouldn't hesitate buying into uncertainty. If levels are attractive, we would go out and buy.
But would you want to bring down, so is there a target cash level that you want to come down to, and what's the direction that you're taking? Would the cash levels be deployed in the first half more than the second half, or the second half more than the first half?
That would be driven by the market or the stock prices and the valuations. It may so happen that if there's a big correction before the elections, we would go out and buy. If the valuations are not attractive and we are not comfortable buying at a particular price, we would wait out. So there's no target level saying that we need to be at this level before elections and after elections.
But broadly, in any kind of a scenario that plays out, either one of the major parties comes back with a thumping majority, or there's all that talk about a third front, do you think the markets would still end up giving a positive return? Because unlike 2014, where the Modi wave had started pretty much from the start of the year, it's very hazy, in terms of expecting what the election result would be like and what the impact on the markets would be then.
Correct. The people in the financial markets are the worst people to ask about elections. We get it consistently wrong. So let's say in the US, people said Clinton will win, and if Trump wins, there'll be a crash. None of those things panned out. In India, again, coalition government.
Or Brexit
or anything in India as well. So 2004, what can be worse than a minority government supported by communist parties, right?
Yeah.
And we had down circuits in the Indian stock markets, and 2004 to 2007 was one of the best bull runs that we have seen. So elections will matter 3 months before, 3 months after the elections. But then I think people will move back to earnings and corporate performance.
Okay. But in the last 3 months, you know, after that shake-off in October and the recovery thereafter, the fact that we are almost at that 11K mark already and completely disconnected from the way the global markets have panned out, are there any names or sectors or stocks wherein you've either increased your weightage or sold out completely from your fund holdings?
We've been adding to our existing positions. The only stock that we added in the domestic market was Hero MotoCorp,
Okay.
which again had sold off for some extraneous reasons, and we felt it was attractively valued. In terms of places where I see opportunity going forward, I would think that the banking sector, retail has been doing well. Corporate has been suffering from the bad loan problem, but I think that's coming closer to an end where most of the problems are behind them. There will be differences between different banks. Some will recover faster, some will still take a bit of time to recover fully, but I think that space one should see lower NPA provisioning and loan losses going forward.
Okay. Why Hero MotoCorp, besides the fact that it has been beaten down? Because it seems that the entire auto segment is under pressure, and it's going to take a while before you really see a meaningful recovery in the sales numbers and across the board, not just two-wheelers.
So this we purchased when there was a very sharp sell-off driven by 1 month number and the fear that hike in insurance premium upfront would result in a big fall in sales and all. If we are talking about earnings growth, discretionary purchasing power growing, auto sector will do well, and in the two-wheeler space we have seen that people have not gone in for too much price competition, and all the players have had decent earning numbers and return ratios. So I think that should continue going forward. It's pessimism built into the current prices, and that's why we went and bought it.
What are you expecting from the upcoming earnings season? What cues are you going to derive from how Corporate India reports Q3?
I think one space where one should watch out, and it may not necessarily pan out in Q3, but even going forward, is I think people are underestimating the pain in the NBFC space. A lot of RBI attention was on banks in terms of asset quality reviews and audits and things like that. For a while, NBFCs were able to access wholesale markets, and again, the end use in some of the cases was not that clear. Given that after this IL&FS issue, people are worried about NBFC exposure, and let's say mutual fund sector will bring down exposures. I think the good quality NBFCs will shine in the environment, but some of the NBFCs could face issues going forward.
Okay. That's that on NBFCs. You've told us what you like. What is it that you would avoid, given that the first half of 2019, most say up until the elections, is going to be a volatile period?
I think, again, being a broken record, this is something I've been saying for a year and a half, but consumption looks extremely expensive. We have seen corrections in some fancied names, but still overall it's not attractive as of now. So you will see volume growth in some of these, you will see earnings growth, but the starting valuations are so high that investors may not make much of returns.
Give us your own sense on how you'd be looking at sectors like real estate, cement, in the wake of all that talk about them being brought under the GST ambit, and purely what that would do for your sectoral allocation, because right now we have a big bias towards consumers because there have been consistent returns there. Is there a strategy which is tilted towards diversification in some of the beaten down names, especially the investment-led themes? So how do you draw that balance?
So cement, my feeling is whatever benefits eventually as and when they come from GST may not be retained by the companies. It would eventually get passed on to the consumer, given that it's a competitive sector and given that there would be some amount of underutilized capacity.
Sure.
And real estate, I think the bigger issue than GST or than cement prices is the steep rise that we had seen in the past, and still we are not at clearing levels, meaning the selling price is still higher than what the buyer can afford. Land parcels and real estate essentially is raw material for these developers. They have to buy land, quickly sell it and move on to the next project. What is happening is they are stuck with inventory. Now this inventory is going on accumulating interest costs for the developer, and sales are not at the levels at which they should be. So I am cautious on the real estate space, and in cement I think prices would get passed on to the end consumer.
Okay, Rajeev, great to have you in the studios. Thanks so much for taking the time.